In corporate finance, strategic investment decisions are crucial. Capital budgeting provides a framework for evaluating long-term investments to enhance shareholder value. It involves assessing potential investments in fixed assets, like property and equipment. Financial managers use tools like net present value, NPV, and internal rate of return, IRR, to evaluate profitability. NPV calculates the present value of future cash flows, while IRR represents the project's rate of return. These metrics help allocate resources to projects with the highest potential returns. Effective capital budgeting aligns investments with strategic goals for sustainable growth. Understanding industry and competitive landscape is key to making informed decisions. Traditional capital budgeting methods often miss the dynamic nature of business. Real options analysis introduces managerial flexibility in investment decisions. It acknowledges that managers can adjust strategies based on market conditions. This flexibility can unlock hidden value that traditional NPV analysis might overlook. Real options include investment timing, abandonment, and growth options. Incorporating real options helps navigate uncertainty and make informed choices. This is crucial in industries with rapid technological advancements and volatile markets. Capital budgeting evaluates long-term investments in fixed assets. These investments shape a company's future profitability and competitiveness. A well-defined process ensures investments align with business objectives. Capital budgeting deals with large, irreversible investments with long-term implications. A disciplined approach minimizes risks and maximizes returns. The process involves generating investment ideas and forecasting future cash flows. Accurate cash flow projections are crucial for evaluating financial viability. Sound capital budgeting decisions determine long-term success or failure. NPV and IRR are fundamental metrics in capital budgeting. NPV measures the present value of future cash flows, minus the initial investment. A positive NPV indicates value creation, while a negative NPV suggests value destruction. IRR represents the discount rate at which NPV equals 0. If IRR exceeds the cost of capital, the project is financially attractive. NPV is favored for its robustness, while IRR is intuitive for comparing similar projects. Both metrics guide strategic investment decisions. Understanding their differences helps in making informed choices. Understanding cash flow patterns is crucial in capital budgeting. Normal patterns have an initial outflow followed by inflows, common in new product launches. Non-normal patterns involve multiple outflows and inflows, seen in projects with maintenance costs. Traditional methods like NPV and IRR suit normal patterns. Non-normal patterns can lead to multiple IRRs, complicating interpretation. Modified internal rate of return, IRR, addresses this by assuming reinvestment at the cost of capital. Independent projects can be evaluated individually, while mutually exclusive projects require careful consideration. The project with the highest NPV should be chosen for mutually exclusive projects. Cash flow patterns impact investment decisions. Normal patterns have an initial outflow followed by inflows, common in straightforward projects. Non-normal patterns involve multiple outflows and inflows, seen in complex projects. Normal patterns simplify the use of NPV and IRR. Non-normal patterns can result in multiple IRRs, complicating analysis. MyRR provides a more reliable measure for non-normal patterns. Understanding these patterns helps allocate resources effectively. Financial managers must consider cash flow patterns in their decisions. Cash flow patterns influence capital budgeting decisions. Normal patterns suit traditional methods like NPV and IRR. Non-normal patterns can lead to multiple IRRs, complicating interpretation. MIRR addresses this by assuming reinvestment at the cost of capital. Independent projects can be evaluated individually. Mutually exclusive projects require careful consideration of cash flow patterns. The project with the most favorable cash flow pattern might be preferred. Understanding these patterns ensures informed investment decisions. While the internal rate of return, or IRR, is widely used in capital budgeting, it has limitations. IRR assumes all cash flows are reinvested at the project's own IRR. This may not reflect reality. Companies often have multiple investment opportunities. MIRR addresses this by assuming reinvestment at the company's cost of capital. This provides a more realistic assessment of project profitability. The modified internal rate of return, or MIR, provides a clearer picture of a project's true profitability, especially with non-normal cash flows. Consider a project with an initial investment of $100,000 and cash inflows over 3 years. Assume the company's cost of capital is 10%. The IRR might be 18.7%, assuming reinvestment at that rate. MIR, however, assumes reinvestment at the company's cost of capital. This results in a more conservative and realistic estimate of profitability. By using MIRR, financial managers can make better decisions, maximizing shareholder value. While NPV and IRR are key in capital budgeting, simpler methods like the payback period remain relevant. It measures the time to recover an investment's initial cost. Easy to calculate, it provides a quick liquidity assessment. However, it ignores the time value of money and cash flows beyond the payback period. Despite limitations, it's useful in industries with rapid technological changes. Recognizing the payback period's disregard for the time value of money, financial analysts have developed a variation known as the discounted payback period. This method addresses one of the key limitations of the simple payback period by discounting all cash flows back to their present value using the company's cost of capital. By incorporating the time value of money, the discounted payback period provides a more accurate assessment of a project's liquidity, taking into account the opportunity cost of capital. To calculate the discounted payback period, we follow a similar process as the simple payback period, but instead of using the raw cash flows, we use the discounted cash flows. For each year, we discount the cash inflow using the company's cost of capital and add it to the cumulative discounted cash flow from previous years. We continue this process until the cumulative discounted cash flow equals the initial investment. The discounted payback period, while more comprehensive than the simple payback period, still suffers from some limitations. It still ignores all cash flows beyond the payback period, potentially leading to suboptimal investment decisions. Moreover, the choice of an appropriate discount rate can be subjective and influenced by management's risk tolerance and market conditions, introducing a degree of uncertainty into the calculation. Despite these limitations, the discounted payback period offers a middle ground between the simplicity of the payback period and the complexity of discounted cash flow methods like NPV and IRR. It provides a quick and intuitive measure of a project's liquidity while acknowledging the importance of the time value of money. In practice, companies might use the discounted payback period as a supplementary metric alongside NPV and IRR, particularly when evaluating projects with short time horizons or when liquidity is a major concern. However, it's crucial to remember that the discounted payback period should not be the sole determinant of investment decisions, and a holistic assessment considering all relevant factors, including long-term profitability and strategic alignment, is paramount for making sound capital budgeting choices. Beyond static assumptions. Introducing real options. Traditional capital budgeting often falls short in capturing the dynamic and uncertain nature of the business environment. Real options analysis incorporates managerial flexibility and strategic decision-making into the valuation process. Managers can adapt and make strategic choices in response to changing market conditions. These options to delay, expand, contract, or abandon a project have value. Ignoring these options can lead to an undervaluation of investment opportunities. Real options empower managers to embrace the dynamic nature of the business world. Types of real options. Navigating uncertainty. Real options offer managerial flexibilities to enhance investment value. Key types include investment timing, abandonment, and growth options. Understanding these options is crucial for effective investment decisions. The value of flexibility. Real options in practice. The true value of real options lies in their ability to enhance decision-making in the face of uncertainty, ultimately contributing to shareholder value. By recognizing and quantifying the value of flexibility, companies can make more informed investment choices, mitigate downside risk, and capitalize on emerging opportunities. Consider a pharmaceutical company deciding whether to invest in developing a new drug. Traditional NPV analysis might suggest that the project has a negative NPV, as the high costs of research and development, clinical trials, and regulatory approvals outweigh the expected future cash flows from drug sales. However, this analysis fails to capture the value of the real options embedded in the project. The company has the option to abandon the project at various stages of development if clinical trial results are disappointing or if a competitor develops a superior drug. This abandonment option reduces the downside risk of the investment, making it more attractive. Additionally, if the drug proves successful in clinical trials, the company has the option to expand the project by investing in additional clinical trials for different indications, developing new formulations, or expanding into new geographical markets. These growth options, contingent on the success of the initial investment, can significantly enhance the overall value of the project, potentially turning a seemingly unattractive investment into a profitable one. Real options analysis provides a framework for capturing these valuable flexibilities and incorporating them into the investment decision-making process. By quantifying the value of real options, companies can make more informed choices about which projects to pursue, when to invest, and how to manage those investments over time. This approach is particularly relevant in industries characterized by rapid innovation, volatile markets, or high levels of competition, where the ability to adapt and respond to change is crucial for survival and success. By embracing real options analysis, companies can navigate the complexities of the business world with greater confidence, making strategic investment decisions that enhance shareholder value and position them for long-term growth and profitability. And capital budgeting and real options. Tools for strategic decision-making. Mastering capital budgeting and real options is crucial for informed investment decisions and sustainable growth. Capital budgeting evaluates long-term investments, estimating future cash flows, and assessing risks. Techniques like NPV and IRR help make rational investment choices. Real options analysis adds flexibility, adapting to changing conditions. It provides a comprehensive assessment, especially in uncertain industries. Quantifying managerial flexibilities leads to informed investment choices. Mastering these tools is key for lasting value and sustainable success.